Hey everyone, welcome back to Corporate Decoder. Today we're diving into a financial filing so tangled, it's like trying to build a house of cards during a hurricane. We're talking about a company that's trying to reinvent itself after losing its main customer. Buckle up, it's going to be a bumpy landing. This report is a roller coaster of financial adjustments, strategic shifts, and legal battles, painting a picture of a company at a major crossroads. It's about DIVERSIFIED, a company whose main asset, Air Wisconsin, is scrambling to find new life after losing its biggest contract with American Airlines. The numbers tell a clear story. Tough times, but maybe, just maybe, a glimmer of hope. First off, let's talk about shares. As of March, DIVERSIFIED had over 58 million shares of common stock outstanding. That's a lot of slices in the pie. It shows how many people own a piece of the company. Now let's peek at the money. Looking at the balance sheet, cash and cash equivalents, stuff like regular checking accounts for a company, are down from about 20 million to 8 million. That's a pretty big drop. It looks like they were burning through cash. Diving into the income statement, we see that contact revenues, that's money they made from their main business, are slightly down. $47 I'd rate, but also not a complete disaster. What this report indicates is a drop in revenue. The biggest headline, a net loss of $7.88 million. That's still a loss, of course, although compared to the $11.9 million loss from last year's same quarter, it's technically better, but a loss is still a loss seen. However, let's not glance over the fact that despite all these challenges, the losses are lower than they used to be, which implies they might be doing something right. Now, here is the per share number. The diluted loss per share is $0.20. That's what the company lost in this quarter for every share you owned. Oz, as you can see from the report's tables, the number of shares is slightly lower than last year. This is because of stock repurchasing, meaning it is cheaper to repurchase a share than grow that share. The report later goes on to show net loss. This metric takes preferred stock dividends into account, so let's have a look. That's money they have to pay to some special shareholders before anyone else gets a cut. We get a net loss available to common stockholders, and it goes up to $8.3 million. Cash is king, so how did their cash situation look? They generated $3.8 million in cash from operating activities. Last year it was a negative $16 million, so even though they still lost money, they are making some right moves. There's also a significant line item about what happened to their Series C preferred stock. Basically, it got converted to common stock and all remaining shares got paid out. This is important because it simplifies their capital structure. Also, it's interesting to see a CSP line, a supplemental executive savings plan for executives where the plan's values are added as assets. Air Wisconsin is now leasing aircraft. The 3 months ended June shows that they are now earning some money in interest income from the plane lease. Now to the boring stuff, legal proceedings. From time to time, companies are involved in legal problems, and most companies usually are fine. In this particular case, they mention several lawsuits, most of which seem to be going on right now and are being handled. I expect that might have an impact on their costs due to legal defense fees. Now, the report dives into factors that negatively impact them, like weather, terrorism, etc. Those are not really actionable. Every company has those. The report spends time also speaking of pilot shortages. All airlines are trying to get good pilots right now, and it is quite difficult, as well as labor union costs. Internal controls, this is reportable because something happened. Specifically, they messed up recognizing some income because of a dispute with United, so they had to fix it and are putting in safeguards to avoid mistakes like that again. Here is the biggest risk from the report, their dependence. This should be obvious to everyone, but they depended almost entirely on the American Airlines partnership that just ended. If they can't make another partnership, all of the plane is simply gone, so this is a big bet the company event. As a last bit of risk overview, let's not forget the COVID-19 pandemic, which is still mentioned in the filings. Last point I'll cover is revenue. If they receive revenue that they did not earn and cannot recognize, that affects the amount they can expense and write off, which in turn has potential legal ramifications to its accounting team. Now, what do I think? Air Wisconsin is at a crucial turning point. Axed that on one hand, the numbers show a business that's trying to trim the fat, cut down expenses, and make do with less. The fact that they are even generating any cash at all is good news for investors, and they seem to be exploring new avenues like small-scale charter flights and seeking federally subsidized routes. But make no mistake, the road ahead is incredibly risky. Air Wisconsin lost its biggest customer and now has to find new customers or find new lines of business, and the airline industry is known for being tough and capital intensive. There's so much uncertainty about whether these things will pan out, so invest with caution. Thanks for watching. If you found this breakdown helpful, smash that like button, drop a comment, and of course subscribe for more corporate deep dives.